what are you investing in now? Or what is your outlook at the market? Looking at your crystal ball, what is going to happen in the next 6 months or a year?
Well, I got you beat. My first home mortgage loan was 10.5% FHA fixed. And I thought I was a smart guy that I got a fixed 10.5%. So different point in time. But everybody's crystal ball is a little bit different. It goes to their risk tolerance level and how they feel. We know there's a lot of people sitting on the sidelines right now, just waiting for something good or bad to happen. But I would tend to be of the mindset that you buy in every market and sell in every market. You buy up, down, and sideways. You tend to buy very differently, and you always sell when your business plan is achieved. So you don't sell unless your business plan is achieved, but you're buying in all markets, but you buy very differently. And so, for instance, in the last 18, 24 months,
This is the Real Estate Vibe Show, and I'm your host, Minky Loomba, a real estate investor. Today, I have a very special guest. He's my good friend, Randy Langafender. And please excuse me if I butcher your name. Welcome, Randy, to my show.
Minky, it's a pleasure. Really appreciate the opportunity to be on this morning and just chat with you.
Awesome. So a little bit about Randy. Randy is a founder and president of InvestArk Properties, and he's a general partner in 1,100 doors, representing 110 million in asset under management. He has invested in a total of 4,000 units in multiple states like Texas, Oklahoma, Arizona, South Carolina, and maybe many more. His investment strategy focuses on providing the passive investor significant returns by improving communities using a safe and time-tested approach. He's passionate about helping the busy professionals achieve their goals in real estate and has been part of several national educational programs and is currently a private multifamily coach. So welcome again, Randy, to my show. I'm super excited to have this chat with you today.
Well, thanks so much again. And that's a long bio. Sorry about you had to read the whole thing there, but I should have abbreviated it.
That's okay, no problem. And today we're going to be talking about Randy's journey from W-2 to full-time real estate operator or entrepreneur. So Randy, before we get started, can you briefly share with me your background? How did you become who you are today?
Well, that may be a long story, but I'll give you the condensed version of it. So Randy Langendorfer, Houston, Texas. You gave my multifamily bio there. My wife always accuses me of not sharing our personal story when I get on these podcasts. So I'm married, 4 children, 5 grandchildren at last count. And I recently came to Texas. Well, I came to Texas 10 years ago. And from the Cleveland, Ohio market, my job was winding down there. And I really became convinced I needed passive income. I needed to develop another income stream besides my W-2, as I was at an income level where I was not going to be easily replace that if I were to be laid off. And coming from a private equity company, I knew that was a very real possibility because they only last 5 to 7 years max. So I came to Houston for business reasons and ended up at a large academic medical institution here in Houston, Texas. I was the vice president of compliance, privacy, audit, and cybersecurity. And I just recently stepped away from that job to do full-time real estate investment. And so I am living life large and enjoying it.
Oh, first of all, congratulations for saying goodbye to your corporate job. That's a huge, huge step in our life because we work for others all our life, but we can do the same thing with our own dreams. I'm glad you chose that. So I'm going to ask you this question here. Share with me some of the key factors involved in your decision. Why did you make this decision to leave your W-2 and go 100% in real estate?
Yeah, and I think everybody's situation is different. But for me, it started probably a long time ago when my wife and I, our first house we bought was a duplex. And we lived in half, we house hacked, we lived in half and rented out the other half. So I've always had a really large interest in real estate.
Mhm.
Got busy with, raising a family and climbing the corporate ladder, or thinking I was. And then as I really said, it started for me with that wake up call that I needed another income stream. My wife is a stay-at-home mom with kids, and we have a special needs son. And so she's working probably harder than I am. And so the decision was really around 10 years ago to start finding a passive income stream. And I was at the time a single family hard money lender, and came to Houston, did a couple projects and learned multifamily and just fell in love with it. Started passively investing Vinky in 2014, as we said. And it just led up to more and more. I was in one, it sold it, 2 became 4, 4 became 8. And so it's the multiplication effect. And I didn't leave my job until I was comfortable with the financial aspects of it.
Mhm.
So, if you're blessed and your spouse works and you got benefits that way, it's maybe it's easier for you to quit your W-2 job. But for me, I had to replace a substantial portion of my income, at least. And it was really just a desire, a gut feel that, I wanted to do this. And I had just outlived the corporate thrill. I just wasn't necessarily and passionate about what I was doing anymore. And I just became more passionate about real estate. And, when you get that feeling in the morning, when you wake up and you hit the ground and you say, I'd really rather be doing something else, it's time to really make it happen. So that's what I did.
Yeah, that's a big thing, desire to do something else. And that desire brought you to the passive investing, like you were telling me earlier before the show that you were investing passively for 9 years. We'll have to hear about that journey. I mean, you were looking for a passive income stream, but why real estate? Or how did you get into real estate or thought about real estate that I can make money through this avenue?
Yeah. So it started, as I mentioned, with hard money lending in single family. I had a brother-in-law who had been displaced in a corporate job and started flipping houses and asked me to join him. And I did that for a couple of years, and it was successful. We had gathered with a team in South Florida. We were living in Cleveland, Ohio, and we were doing flips and making good money. But when I came to Houston, I just realized that to get any leverage, any volume was going to be very difficult, because it's just extremely time consuming
Mm-hmm.
to understand the comps and the market that each one they operate in, et cetera, et cetera. It's not bad. But when I heard about multifamily, and so the decisions for multifamily for me were one, the 3 biggest reasons, right, is positive cash flow,
Mm-hmm.
favorable tax treatment, and forced appreciation.
Mm-hmm.
And as a finance guy, those really resonated with me. And the other thing that really turned me on to real estate was when I decided to become an active or a lead investor, it's non-recourse debt. I can buy multi-million-dollar assets, non-recourse.
Mm-hmm.
And that is different than any other asset class or any other business that you do. I had not wanted to jeopardize what I did have in life. And so those are some of the big drivers that got me into real estate, and realizing the other thing is, that I could start this out part-time and grow into a full-time position,
Mm-hmm.
and not have to cut the purse strings altogether.
Mm-hmm. I love that, how you transition slowly and at a pace, with your W-2, investing passively for 9 years and just building your foundation. And during that time, you were doing some flipping too. And then eventually you transition into multifamily. And you told me that there are 3 things that's very lucrative about multifamily. I think that drew my attention as well: the cash flow, the appreciation, and the tax benefits. Because a lot of people are looking for the tax benefits, which is like really, really cool that you can do in multifamily with all the cost segregation and the bonus depreciation, which you do not see anywhere else that convenient, right? So I'm going to go back into your journey, and we're going to talk a little bit about your flipping, because a lot of people are still flippers. They're flipping properties. They're doing rehab and flipping, or they're just like this. That's a different asset class, but still people are making money there. So I wanted to understand the hassle that you go through with flipping the properties, and by the end of the day, what kind of profit you make. And here you're investing passively as well for 9 years, and you're generating the cash flow there plus the appreciation.
Yeah.
What is the difference between the two experiences and which one was better for you?
Well, first, I could never find a way in single family to be passive.
Mm-hmm.
It was active. I had to find the house, develop the contractors that were going to make the rehab, put together a budget, attract lenders. And so I just, I guess you could say hard money lending was kind of passive, but it was very active to get it situated. And so that's one thing. It just became difficult because they turn over by design, hopefully every 6 to 7 months. So even if one is successful, it turns over and you got to go out and find the next one. Being new to the community of Houston, it was just very difficult.
Mm-hmm.
The fourth largest metro area in the U.S., to gain a comfort with all the different submarkets and which areas.
Mm-hmm.
So when I went to a large educational group here in Houston, one of their events, and that's where I really heard about multifamily for the first time. And I can even mention it's Lifestyles Unlimited here in Houston, and they have an annual expo. And I went to that, and I remember at the time there was a gentleman there by the name of Brad Sumrock,
Mm-hmm.
who was teaching, and 3 different sessions, and I happened to hit his first session. And I was so enthralled by it, the conversation of non-recourse debt, very handsome returns, passive investing, set it and let it go. And that's the way, if you want to start that way, you can be active. I sat through all 3 of his sessions and heard the same thing 3 different times the same day. And I was just all in. And I just remember coming home and telling my wife about it. And, she was, like most spouses, may not be interested as much as I was, but she was gracious. And, and from there on, I just got really interested in learning all aspects of multifamily. And so I did start out as a passive. It was only about 4.5 years before I became an active out of the last 9. But I just wanted to learn every aspect of it. And I think that encourage your listening audience. That's the best thing I always talk about, is educating yourself. Take good risk. Don't take blind risk. And because there are unscrupulous operators out there sometimes.
Yeah, you said it very well. Always try to calculate the risk, or in other words, take calculated risk. You should know what you're getting into. Yeah. So in this journey or this transition from corporate to flipping to passive and now active, what are some of the biggest challenges you faced during this transition, and how did you overcome those?
I'll go way back to you. I remember the first time I invested passively in a multifamily. Most, for your listening audience, most of them are a $50,000 entry fee, and I was even reluctant to do that. My background, as I may or may not have mentioned, finance, CPA, and so you would label me as risk adverse. So I went out and found a partner to go along with me the first time. We split it, and just because I was so risk adverse, to learn the process. But I took that, and I decided to actively engage with the lead partner or the active partner. And I asked him beforehand if I could pick his brain along the way, or, I was volunteering to go out and do site walks or unit walks and stuff like that. And it was very helpful for me to learn. And some of the other big challenges were me just getting over my paradigm of that risk adverse. The finance people, the IT people, the engineers of the world are all very analytical types, as well as I am. And I think, I had to delve into every aspect of that spreadsheet and understand it before I could write a $50,000 check. So I think first and foremost was the mindset to get over. And then I remember writing my first check, and my hand was actually shaking and writing it. And it turned out to be a wonderful investment. But I think the first one is mindset, and educating yourself are the really big ones. Because, even Warren Buffett says, he doesn't believe in diversification. He says, because you can just get the market. He goes all in on a specific asset class when he understands it. But before he ever does that, he really digests it, understands the risk. And that's what's going to make an investor from a speculator, right? A speculator is somebody that just throws money at us, at a mutual fund, because their employer is going to match something. But an investor is one who analyzes the deal, analyzes the risk, and has plans to address those and what they can do about them. So
Yeah, let's talk about that a little bit. Like you say, it's just like a gamble. In other words, if you do not understand 100% what the deal is all about. But I would say over here, a lot of people, they invest in stocks and bonds. Stock market is still like more percentage people investing in compared to real estate. A lot of people do not even know this avenue that they can put their money in the private placement, which is like, I would say it's much more solid than stocks and bonds, because stock market, you do not know who you're investing with. Just putting the money out, Apple is going up, Microsoft is going up, but tomorrow it could be down too. And most of the time, people buy the stock when stock is high and they sell the stock when it's low because they ride the wrong wave all the time, most of the time, I should say. And then they think, oh, they'll make money. But some odd reason, there's like more trust versus this avenue, real estate, where you can make money. You cannot go wrong because it's a marathon, it's a long-term game. And you just mentioned that too. Earlier when you started, you said you were a little shaky writing a $50,000 check. So let's go through that mindset. And how did you overcome that? And then what helped you get like a little bit more confidence or more trust into real estate over stock market?
Well, and I think you hit it on the head. I mean, there are so many people that just blindly, I call them speculators, and I do it on my corporate job when I had, to put money in a 401k.
Mm-hmm.
I could never find the money manager in my 401k. And if I did, he or she would never take my call, right?
Mm-hmm.
But as active investors or lead sponsors are taking calls from our investors all the time. They have my cell phone number, my emails, and ask questions many times on the monthly reports. But I go back to simply that hurdle of making the initial investment as an investment. I viewed it as an investment in myself, the education. I tell people, there's many ways to do that. I mentioned I'm a coach, but there are many of these large multi-educational groups that mentioned to some of them, Some Rock Lifestyles, Jake and Gino, Michael Blanc, Mark Kenny. They're all great organizations. They all provide value to the person who's coming on board. But you have to educate yourself and understand what a PPM is, what a syndication is. But I think you would agree with me, the most important thing that an investor can do is to build a relationship with the party, the active or the sponsor or lead partner, whatever you want to call them, person putting the deal together. Do you know, like, and trust them? Are they competent? Have they done deals before? Have they had good returns? And if somebody tells you they've never had a horror story, then they're probably exaggerating the truth, because everybody has dips in their journeys, and they happen. But so, and by, hanging around people like you, go to meetups, go to these education, listen to podcasts. There are tons of opportunities that weren't there even 9 years ago when I started, for the listening audience to educate themselves. And it's a small community. So if there's a bad apple out there, you can just ask. You can probably ask 5 people if they know Randy Langendorfer, and if they do, what do they think of him? And probably have heard of me or haven't heard of me. And if you do, that's fine, and got an opinion. So education is the key to me to that answer of getting over the initial hurdle of making your first investment and every subsequent one. So you just have to, I know you're the same way. They come comfortable today. The team. I used to do a tremendous amount of due diligence as a passive investor. Today, I've got a couple people, 3, 5 of them that I invest with routinely. They send me a deal and I send them a check. It's gotten to that point. But the first times I drove to the asset, or I flew to the asset, I looked at it, I drove the comps, et cetera, et cetera.
Yeah, that's what you said. Know, like, and trust. People only invest with the people that they know them, they like them, and they trust them. And that relationship is built over time through networking. You nurture the relationship. And also you mentioned the due diligence and, nurturing in different ways, and trying to educate yourself, getting all the content that's being pushed out to them, going through that. You just need to learn the lingo. I would say, or maybe understand the concept if you don't want to be active, because a lot of people are not looking for an
Right.
active participant as well. They wanted to do something passive because they are so much in love with their jobs or their businesses, whatever they are doing at current, they wanted to stick to that. But on the side, this avenue is available for them to multiply their money hands-free. But the only thing is no like and trust plays a big role in there. And then see how these operators or syndicators are treating them, what their communication style is, and how they're bringing these opportunities to them. And which you said, early on when you were doing diligence, you were just flying out, checking out all the properties yourself. But now you have built all this trust relationship with the individuals that you feel comfortable enough writing them the checks without doing any other thing. So how did you do that? I mean, we know you did the education, you did the networking, but what is that gave you the comfort level, if you go back and think about when you were writing your first check and now you're writing the check without even thinking, what has shifted in your mind?
That's well, it's a loaded question, but a good question. I think what has shifted is one, experience. The 9 years, having been full cycle on 15 deals over those 9 years and seeing the benefits. So, I said I'm a financial mindset. So I've gone back and I've analyzed, just for your listening audience, to talk about the potential financial rewards over those 9 years. I think I've gone through 10 or 15 deals. I can't remember exactly. I have a spreadsheet someplace, but I've returned an average of 1.65 equity multiplier, an average. So that means for every dollar I've invested, I've gotten $2.65 back. Mm-hmm. So there's the enticer. Mm-hmm. It's very good returns. Mm-hmm. Because you got to understand, you got to like the asset class. Everybody needs a place to live. They may not need the next retail center or the next office center, but everybody needs a place to live. Mm-hmm. And I keep going back to that. And with increased population and demographics, anyhow, I got started off that track there. So it was education. It was experience. I didn't jump in, writing many checks at first. I did one. I did one and waited a couple of years and wrote it and see how it flew, and then did another one and then did another one. And so, start slow as well and go as fast as your comfort level allows you. Some people want to go big, go fast. I wanted to go slow, go slow and go comfortable. And so that's just my personality. But it's like anything, right? People get married, they're scared, but they date. So you got to go through that courting relationship, and maybe a poor illustration, but the same way on investments in multifamily, you got to start and build relationships, go to conferences, listen to podcasts, go to meetups. I'm living proof it's not rocket scientist.
It is not. I mean, you said build your base, and you said very good thing that experience, experience is very big role player in this thing. When you didn't have the experience, you were hesitant to write your first check. So now you have all those positive experiences. And you talk about the negative too, that everybody has some negative when you're in the real estate. Yes, but the thing is, the timeline is 3 to 5 years or 7 years, right? In that timeline, you could go up and down, but as long as you're, passing in the flying colors, the deal is good. In the middle, there could be hiccups. Deal could go up and down. As long as you still hold on to the deal and then you exit it successfully, that's what counts. So having all those experiences added to your previous experience and expanded your mindset, and now you're not hesitant. So whatever is not in our experience or perception, we are hesitant to do it. So that's the reason people say you get the knowledge, you educate yourself, create that experience for yourself that you're comfortable to take that action. And every action, I would say, creates a new experience for you. And every action taken now is very important because it's going to decide your future, your destiny.
And I can agree anything more than what you said. I just wanted to expand upon what you said when you asked the question. I think a couple other factors for me are risk mitigation factors. So we talked about the first being the sponsor, to know them, ask people what they think of the person if you're going to use them. I mean, and the other one is I focus on the Sun Belt, so southern half of the United States, where I'm in South Carolina, Texas, and Arizona, large population growth, large income growth. So that's another risk mitigation factor. I mean, somebody asked me about, said I got a deal now, and I'll just throw out Topeka, Kansas. I hope none of your audience is from Topeka. I don't know anything about it. And it may or may not be a good deal, but I say I increase my probability of success by looking in those high growth areas. Don't buy in the hood. If somebody's got a deal that's, a lot of Section 8 housing and stuff like that, walk away from it. Buy invest in newer assets, Class Bs and Cs and A minuses.
Mm-hmm.
The first deal I ever did, my guy told me not to do as a general partner. It was a 1965 build, chiller, boiler, flat roofs. I shouldn't have done it, but we ended up doubling investors' money too. So it turned out to be good, but it was a heck of a ride. So those are learn the risk mitigation and build your own investment strategy.
Mm-hmm.
Do you want to invest in Topeka, Kansas, or do you want to invest in Florida?
Mm-hmm.
It's avoiding the shiny object syndrome. So if somebody comes to you with that 25% IRR in Alberta, Canada, no, thank you. That doesn't fit my investment criteria. Or yes, it does. So it's important for your listeners to start to I encourage people I talk to put pen to paper, even if it's 5 bullet points of what you want to invest in.
Mm-hmm.
Are you going to do multifamily only, or are you going to do commercial and single family and residential and other asset classes? If you don't put some of that stuff on paper, you're going to be attracted by the shiny object syndrome and lessen your risk. Increase your risk. Increase your risk.
Yeah, that's true. And also you might want to evaluate your risk appetite, how much risk you can take,
right.
And how much risk you're willing to take. That's very important too, because that way your experience is going to be totally different then. But if you put the money in, let's say, even stock market, real estate, wherever, and then you're always worried about it, what's going to happen, something will happen, which you're not going to like it, because people always say that you expect the unexpected. But if you think that thoroughly, that unexpected is actually expected, because you're creating that with your mindset, because you're thinking that, oh, I hope that not happen. I hope that not happen. Guess what? That's what happens. So you were expecting that, but it was not unexpected. It's just like twisting the words, but that's the truth right here. So let me ask you this question now. What would you recommend to somebody who has a full-time job, who's a full-time professional, loves the job, and wanting to invest, create another passive income stream? What would you recommend to that person?
So I have several investors like that. I tend to attract the corporate person who's mature and been doing it for a while. And, I started out, I tell them my journey. That's the way I started out, because I needed another passive income stream. So I would encourage them to, let me tackle the question from a different way. I came from a large academic medical center that had $1.5 billion, that's with a B, in endowments. And they started out 10 years ago, and I started the classic portfolio diversification strategy of stocks and bonds. And then an alternative asset class grew into it. And now, fast forward today, they have an asset class they label as real estate. Mm-hmm. So anywhere from 8 to 12% of 1.5 billion is in real estate. Mm-hmm. Why? Just because all the things we've talked about. So I would say to your corporate person, if nothing else, it's just another diversification strategy away from the stocks and bonds and the market cycles that you can't control. Real estate rises and falls too, but it's much less susceptible than it is the stocks and bonds. And if you look at the wealthy people of the world, many, many, many of them are doing a lot of private placement offerings and are doing real estate. So I think market diversification is why you should get into real estate, and for all the reasons we said, and start out small and educate yourself. Call Vinky or call me, and we'd be glad to help you walk along the journey.
Yeah, and then you said it very well. All you said, the rich people, all the wealthy people, they have real estate in their portfolio. So it's basically, when you are investing passively, I would say, you're just hiring people to find the deal for you, and take the deal from conception to completion, and then give the returns to you on your investing, whatever investment you put in. On that, you give you the return without you doing anything, you're just putting the money in. So basically, you're hiring the whole company to work for you, to do the whole work end to end. And what could be better than that? If you think about that, that's how wealthier get wealthy, because they know this game. They know how to play this. And they've been doing it for last so many years, 40 years, 50 years. If you check the track record, all the millionaires, billionaires are made out of real estate, or they do have a portion of in their portfolio as real estate, right? And they're still doing that.
Beyond their primary residence, I say too.
Exactly.
So beyond their primary residence. And I think, I don't know about you, but I would say, I know a lot of people that have probably 100% of their net worth in real estate. I still have some from my corporate days because I'm kind of locked in for a while, but I'm about 50% of my net worth is in real estate, and growing, I'll say, just because of earlier today, I was looking at my bank account, and as I was recording all the deposits I received in the last week.
Awesome.
It was a good day.
Awesome. But other than that, you can do your 401k too. We didn't touch that. If you're a corporate employee, you can leverage your 401k too. So I would like you to talk about that as well.
That's how I got started, actually, because of the risk adverse. So I actually got started with, transferring some of my corporate IRA money to a self-directed IRA.
Mm-hmm.
And there's several self-directed IRA custodians across the country. We can get you some if you're really interested. But the self-directed IRA, your employer 401k won't allow you to invest in these. So it has to be money from a prior employer or something like that. Your current employer won't let you do it until you leave. But once you leave or have money from a prior one, you can transfer it to a self-directed IRA and then invest in a private placement offering. And your world becomes very large at that point of what you can invest in. And many of those custodian companies offer education as well on how to look at deals and deal sponsors and tax advantages and et cetera, et cetera. So there's another educational opportunity for your listening audience. I'll just mention the two biggest ones in the country that I know of are Quest IRA here in Houston, Texas, and Equity Trust in Cleveland, Ohio. Your audience can just go out and Google those and start signing up for their newsletters, and you'll get a plethora of information available to you.
That's true. There's multiple custodians out there. But I wanted to mention one more thing over here. If you're in service, so a lot of companies, they let you do, it's called in-service rollover. So you can take portion of your 401k and then you can roll over. It could be like 30%, 40%, depending upon the company. But you have to check with your company how much they can let you roll over while you're in service. So that you can move into your, self-directed IRA account and then have your custodian manage it for you. And then you're able to place that money into the private placement. You can basically put the money anywhere as long as you're not putting into, I think, liquor or crypto or something like that. But other than that, you should be able to invest anywhere. But let me ask you this now. In today's market, the market is so volatile. Interest is all-time high. And I think they're going to raise the interest a couple more times this year. And if I look back, I think this kind of situation, interest rate, I saw that 30 years ago when we bought our first home, we bought it at 9.75 interest rate. Can you believe that? So now we are kind of at the same place in a different situation. So what are you investing in now? Or what is your outlook at the market? Looking at your crystal ball, what is going to happen in the next 6 months or a year?
Well, I got you beat. My first home mortgage loan was 10.5% FHA fixed. And I thought I was a smart guy that I got a fixed 10.5%. So different point in time, but everybody's crystal ball is a little bit different. It goes to their risk tolerance level and how they feel. We know there's a lot of people sitting on the sidelines right now, just waiting for something good or bad to happen. But I would tend to be of the mindset that you buy in every market and sell in every market. You buy up, down, and sideways. You tend to buy very differently, and you always sell when your business plan is achieved. So you don't sell unless your business plan is achieved, but you're buying in all markets, but you buy very differently. And so, for instance, in the last 18, 24 months, everybody was buying on variable rate debt. Fast forward to today, I wouldn't look at a deal with variable rate debt today. It's got to be fixed rate debt and probably agency for consistency and continuity. So that's just one example of buying. And, people used to buy in pro formas, where now we're returning to the old days where you're buying on historicals. Mm-hmm. And that's much more conservative. You're buying today and it's further less risk to investors because you're not getting as much leverage. When I first got started in this business, I remember getting 80 and sometimes 85% leverage.
That's true.
Today, it's down to 60, maybe even 55% leverage. So in that alone is less risk for the investor because you have less debt on the property, and much leverage. So interest rates are going up, yes. So are rents. And so I think that has both a negative and a positive. Rates are rising, but so are interest, I should say, lease payments or tenant rents. I think the challenge for operators today is expenses are going up as well. And the real good operators are differentiating themselves by making that delta between income and expenses. Still the net operating income, as you know. And that's where good operators are distinguished from, I think, average or poor operators.
Yeah, as long as they're being creative and figuring out a way how to manage it better, they can definitely fit that in. So we're out of time. Can you share one golden nugget with my audience?
The golden nugget I would say is invest in yourself by educating yourself and take action.
I like that. That's awesome. So this brings us to our Vibe rapid fire round. I'm going to ask you 5 questions. You have to answer in one sentence or one word only. Ready?
Oh boy.
All right. The first question is, what is one of the most important thing that you've learned in your life? And how did your life change after learning it?
One thing, I want to give you 2, but I'll say one thing is the value of education. And that education, this is longer than one sentence, but education relates to personal and business, educating myself in personal relationship. And then what was the second half of that question?
How did it change your life?
How did it change your life? Forever better. The 2 short words, forever better, both in the personally. I keep thinking I've been married to the same woman for many years, and I got a great education that I don't regret my corporate experience at all. So I think it made me a better real estate investor.
I like that, because when you're educating or acquiring more knowledge, you're expanding your horizons. That's the best thing that you can do to yourself. So share one good book that you have liked and recommend to my audience.
Yeah, the one book that I consistently like, and I don't know if I can put my hands on, The Hands-Off Investor by Brian Burke.
Yeah, that's a good one. Mm-hmm.
And that is, I was just looking at the title of it, by Brian Burke. He is, for the passive investor starting out, that's a great read.
Yeah, I have that one too. That's a good book. In one word, what does life mean to you?
Enjoyment, I guess, or fulfillment.
That's good. That's a really good one.
Really good one. What's life mean in one word? Okay.
What is your biggest passion?
My biggest passion, real estate. That's easy.
That's good. So if you could turn back in time and talk to your younger self, what would you tell yourself and why?
I would tell myself to take action earlier in life than I did. And that would be the simple answer. I'd take action earlier in life. And why is only because I got a great education through my formal education in college and corporate world. But I don't think you need that to be successful in real estate. And the gig economy today and the entrepreneurial mindset that's out there is there's so many different ways to make money, and real estate's just a really good one.
That's good. So how can people reach out to you, Randy?
Well, thanks, Linky. It's a pleasure to be on your show again. The easiest way is to go to my webpage, invest-ark.com. There's a contact me out there. I'd love to chat with your audience. I'm also on LinkedIn and Facebook and Calendly out there as well. So I'd love to talk to any of your audience about real estate or anything else that's on their mind.
Thanks for being on my show, Randy. I really enjoyed our conversation today.
Thank you. I appreciate you, and have a great day.